I want you to take a second and just think about your wallet or your purse right now.
Yeah, whatever you have on you.
Right. You likely have this small piece of plastic, or maybe it's one of those heavy metal ones, just
Yeah.
sitting in there.
Mm-hmm.
And when you take it out and tap it at a terminal, it feels like a magic wand.
It really does.
You want a coffee, you tap the card, you get the coffee. You want a flight across the country, you literally type some numbers on a screen, and the flight is yours. But we need to ask a very critical question today. Is that piece of plastic a highly efficient tool that makes your life easier? Or is it a brilliantly engineered trap, one that's designed to extract wealth without you ever even noticing?
And that is the exact tension we are going to explore. So today we are taking a deep dive into the hidden mechanics of credit cards, and we've got a really fantastic stack of sources to guide this analysis for you.
We do, yeah.
We're pulling insights from a deeply technical video breakdown by the YouTube channel Explains 101, along with 2 incredibly thorough architectural reviews of the modern debt system. One is an article titled The Architecture of the Credit Card Trap, and the other is this long-form piece called The Credit Card Blueprint.
Which are both incredibly detailed.
They are. And our mission in this deep dive is to decode the raw machinery operating behind the scenes. We want to strip away the flashy rewards, the complex billing cycles, and all that marketing rhetoric to look at how the system actually monetizes consumer behavior.
I think it's crucial to approach this without the usual financial preachiness.
Absolutely.
We aren't here to label credit cards as evil or inherently bad. We're just here to look at the engineering. It's a system that touches almost every adult on the planet, that very few people understand the underlying algorithmic and behavioral models driving it.
Right.
The sources make a really compelling argument, which is that the credit card industry doesn't need everyone to default and fail. In fact, mass defaults would bankrupt them.
Yeah, that's the last thing they want.
Exactly. They just need enough people to fundamentally misunderstand the product they're holding in their hands.
And the profitability relies on a very specific spectrum of consumer behavior. So to really grasp that, let's start with a brief overview of the core concepts. We need to distinguish the functional difference between debit and credit, and not just in terms of where the money comes from, but in how the financial transaction is routed and honestly how it's perceived by you, the consumer.
Right, because on the surface, the user experience is identical.
Completely identical.
You tap the terminal, it beeps, you walk away.
Yeah.
Now with a debit card, we all know it's a direct pipeline to your checking account. The money is yours. When you spend $50, a digital ledger updates, and your available cash drops by $50 instantly.
The latency there is zero.
Zero. The latency between the purchase and the depletion of your capital is non-existent. But credit operates on an entirely different architectural premise.
It does. The word credit actually comes from the Latin credere, which means to trust. So functionally, credit just means debt.
Right.
When you tap that credit card, you are not spending your own money at all. You are executing an instantaneous, unsecured microloan. The lender, which is the bank that issued your card, is essentially stepping in and paying the merchant on your behalf. And they do this based on the trust that you will reimburse them at the end of the billing cycle.
And the video from Explains 101 uses this great concrete analogy to map this out. Let's think about a restaurant tab.
Oh, I love this analogy.
It's so good. Using a debit card is like walking into your own pantry at home and making a sandwich. You own the ingredients, you consume them, and your pantry is now tangibly emptier.
You feel that immediate opportunity cost. You literally have less food in your house.
Exactly. But using a credit card is like running a tab at a bar or a restaurant. You sit down, you order a meal, and you get the immediate utility and enjoyment of the food.
Yeah.
But the bartender's just making tally marks in a ledger.
Right, you're not handing over cash.
Right. No, during the meal, you feel zero financial friction. The consumption is completely decoupled from the cost. It is only at the end of the night, when the tab slides across the bar, that the reality of what you consumed actually hits your balance sheet.
And when that bill arrives at the end of the month, the way we react to it is heavily manipulated by this concept of the credit limit.
Oh, the credit limit.
Yeah. When a bank issues you a card with a $20,000 limit, they send you a congratulatory letter.
It feels like a promotion.
It does. It feels like an endorsement of your financial stability. Like they're saying, look how much you're worth.
Which is just a brilliant piece of psychological framing. The architecture of the credit card trap spends a lot of time on this specific illusion.
Yeah.
That $20,000 limit is not available capital.
No.
It is not an asset. It is strictly your allowed debt capacity.
Allowed debt capacity, exactly.
It represents the maximum threshold of risk the underwriter is willing to expose themselves to based on your income and your credit history. But by framing it as a limit or a line, it anchors the consumer's perception of their own wealth artificially high.
That anchoring bias is so fascinating to me because if you have a $20,000 limit, putting a $2,000 vacation on the card feels like you're only using 10% of your
It
resources.
feels incredibly safe.
Yeah, it feels totally manageable. But if your limit was $3,000, that exact same $2,000 vacation would feel like a massive risky expenditure. The banks are manipulating the denominator in your mental math to make the spending feel less significant.
And this brings us to the core behavioral concept that makes the entire industry tick, which is the delay of pain.
Right.
Behavioral economics shows us that humans experience a literal, measurable neurological pain when handing over physical cash. The loss of resources literally hurts, but the credit card system is meticulously engineered to separate the dopamine hit of acquiring an item from the neurological pain of paying for it.
Because that pain is delayed by 30 to 45 days, the spending feels frictionless.
Completely.
You buy the shoes, you get the immediate serotonin boost, but the cost feels like it belongs to someone else. It feels like a problem for future you.
Yes, future you.
Yeah.
And human psychology dictates that we do not protect future you with the same intensity that we protect our present selves.
We treat our future selves almost like strangers.
We really do. We assume future me will be richer, more disciplined, and perfectly capable of handling the bill. So by removing the immediate friction of the transaction, the system inherently suppresses our natural financial defense mechanisms.
You know, this actually brings up a huge question. And here is a knowledge gap for you to explore next for anyone listening.
Yeah.
Our sources do an incredible job explaining how modern credit cards exploit human psychology today, but they don't really dive into the history of how society made this massive shift.
That's a great point.
Right. When exactly did we transition from a culture that historically stigmatized debt and prioritized saving up for purchases to a society that relies on instant revolving credit for everyday survival?
Was it a slow cultural drift, or was it engineered?
Exactly. Was it engineered by specific financial deregulation in the 70s and 80s? Unpacking that historical pivot point is crucial for understanding how normalized this has all become.
It's a profound shift to investigate. The normalization of debt completely rewired the global economy. But to truly understand the modern implications, we need to transition from the theoretical psychology to the practical reality.
Let's do it.
If we look at some notable cases, we can see exactly how these mechanics operate at the point of sale. So let's walk through case study A from our sources, which is the $1,000 smartphone purchase.
Very relatable.
Highly relatable. This is an everyday transaction. Imagine you have exactly $1,000 sitting in your checking account, and you walk into a store to buy a new phone that costs exactly $1,000.
The divergence in experience here is stark. If you choose to pay with your debit card, the transaction processes. The funds are pulled directly from your checking account via the automated clearinghouse or the debit network, and your balance instantly drops to zero.
You feel it immediately.
You walk out of the store with a new piece of technology, but you feel that heavy vulnerability of having no liquid cash left.
But if you decide to put that same phone on your credit card, the psychological and financial reality completely splits.
Right.
You swipe the card, the transaction is authorized in milliseconds, and you walk out of the store with the phone. But when you open your banking app in the parking lot, your checking account still proudly displays $1,000.
It feels like an arbitrage.
It does. You have the asset and you still have your capital. But the reality is that you just initiated a complex liability. You owe the issuing bank $1,000, and the terms of that repayment are dictated by a 30-page cardholder agreement that you likely never read.
Which nobody ever reads.
Nobody. You've traded actual liquidity for a delayed obligation.
Now, I want to push back a little here because the immediate counter-argument from savvy consumers is always about the perks.
Oh, of course, the rewards.
Right. They say, but wait, I am going to pay off that $1,000 at the end of the month anyway. I use the credit card specifically to get the cashback and the airline miles. The bank is essentially paying me to use their money.
And this brings us right to case study B, which is the airline points illusion. It is the most common defense of credit card usage.
It is. So let's break down the actual mathematics of the rewards ecosystem. The credit card blueprint lays this out perfectly. A standard rewards card offers an earn rate of roughly 1 to 2% on general purchases.
Either delivered as literal cash back or as proprietary points.
Exactly. So on our $1,000 smartphone, a 2% return yields exactly $20 or maybe 2,000 points, depending on the specific conversion ratio of the issuer's program.
And $20 is $20. It feels like free money.
It does until you contextualize the redemption value. The sources highlight that when you look at actual airline award charts, a standard domestic economy flight often requires anywhere from 15,000 to 25,000 points.
And if you want to fly internationally in a premium cabin, you're looking at 70,000 to over 100,000 points.
So if we run the math on that, earning 2,000 points on a $1,000 purchase means you would need to spend over $12,000 on that card just to earn the lowest tier domestic flight.
$12,000.
Just for one domestic flight. And that doesn't even account for the taxes and fees the airline still charges you on a quote-unquote free award ticket.
Exactly. The point isn't that rewards don't exist. It's that the psychological weight of the reward drastically outweighs its mathematical value.
It's an illusion.
The rewards are an engineered bait. They act as an accelerant for spending. Consumers begin to justify marginal or unnecessary purchases by focusing on the yield.
It changes the entire cognitive process of buying. Instead of looking at a $300 jacket and asking, does this fit my budget and do I need it? The consumer asks, how close will this get me to my sign-up bonus?
Right. How many points does this category earn?
Yes. You stop evaluating the utility of the item and start gamifying the transaction. And if you buy something you did not inherently need for $100 just to get $2 back in rewards, you didn't outsmart the bank.
No.
You lost $98 of your own capital.
The banks rely on the fact that humans are terrible at calculating net loss when a perceived win is involved.
We're so bad at it.
And this gamification inevitably leads to balances that consumers cannot clear at the end of the month, which activates the most lucrative and dangerous mechanism in the entire system. Case Study C, the minimum payment trap.
Oh, this is where the math gets brutal.
It really does. Let's say you bought that $1,000 phone, plus a few other things, and your statement balance comes in at exactly $1,000. Right at the top of the bill, in a very clear, heavily optimized font, the bank shows you the full balance.
But directly adjacent to it, inside a prominent box, is the minimum payment due. And it might be something incredibly low, like $25.
We need to analyze the behavioral design of that statement. The presentation of that $25 option is not a courtesy.
Not at all.
It is a pressure release valve. When a consumer sees a $1,000 liability, their stress spikes. The $25 option acts as an immediate psychological balm. It feels highly manageable.
It tricks the brain into feeling a sense of financial control and compliance, like, I made my payment, I am in good standing.
But the reality of that compliance is toxic. By paying only the $25, the remaining $975 is rolled over into the next billing cycle. The grace period is revoked, and the bank begins compounding interest on that remaining principal on a daily basis.
We can use a quick analogy here, actually. It is identical to hitting the snooze button on an alarm clock.
Oh, that's perfect.
When the alarm blares at 6 in the morning, it is a harsh, stressful reality. Hitting snooze gives you an immediate rush of relief. The noise stops, and you get to sink back into comfort.
But the snooze button does not actually stop the morning from happening.
Huh.
It doesn't solve the underlying problem of needing to get up. You still have to wake up, but now you have lost 10 minutes. You are running late. Your stress will be higher when you finally do get out of bed, and the alarm is inevitably going to go off again.
Exactly.
The minimum payment is a financial snooze button. It gives you immediate relief from the pain of your balance, but it guarantees that your financial reality will be significantly worse the next month.
It is the single most profitable behavioral tool in consumer finance. By setting the minimum payment at roughly 1 to 2% of the principal balance plus interest, the bank ensures that the debt amortizes incredibly slowly.
Painfully slowly.
It turns a one-time consumer purchase into a multi-year annuity stream for the lender. You are effectively renting the items you already bought, paying a monthly fee just to keep the balance open.
And zooming out to current practices, when you take these individual case studies, right, the illusion of the limit, the gamification of points, and the amortization trap of minimum payments, and you multiply them by hundreds of millions of consumers, the macro reality is staggering.
The data points provided in the architectural reviews are sobering. As of 2025, consumers in the United States alone are holding over $1.2 trillion in revolving credit card debt.
1.2 trillion.
Trillion with a T. That is a completely unprecedented volume of consumer liability.
And it is crucial to remember that this isn't cheap debt. The average annual percentage rate, or APR, on these cards is sitting above 20%. Many retail store cards are pushing 29 to 30%.
To understand why the pricing of this debt is so aggressive, we have to look at the underlying risk models, specifically the concept of unsecured debt.
Right, because if you compare a credit card rate to a mortgage or an auto loan, the difference is massive. A mortgage might be at 6 or 7%. Why is a credit card at 24%?
It comes down to collateral.
Exactly.
An auto loan is a secured debt. If the borrower defaults, the bank has a legal claim to a physical asset with a definable resale value. They send a repo agent, take the car, auction it off, and recover a significant portion of their capital.
And a mortgage is secured by real estate. The risk of total loss for the lender is heavily mitigated by the collateral.
But credit card debt is entirely unsecured. When you use your card to pay for a vacation to Mexico, or a tank of gas, or a dinner out with friends, there is no physical asset for the bank to repossess.
If you lose your job and default on that $15,000 balance, the bank cannot repossess the margaritas you drank 3 months ago.
They cannot. Because there is zero collateral backing the loan, the bank's exposure to total loss is significantly higher. In financial markets, risk is always priced into the yield. The 24% interest rate is essentially a risk premium.
Which means the consumers who do pay their revolving balances are mathematically subsidizing the losses incurred by the consumers who default and declare bankruptcy.
Yeah, that's exactly how the math works out.
Now, this brings up another massive question. Let's say you are the perfect consumer. You treat the card like a debit card. You pay the statement balance in full every single month. You never pay a dime in interest, and you harvest all those airline points and cash back. You feel like you're beating the system.
You feel like a genius.
Right, but the banks are still making billions. So who is actually paying for your free flights?
This is where the architecture gets truly fascinating. The answer lies in something called interchange fees, commonly known as swipe fees. The sources emphasize that rewards programs are not philanthropic endeavors funded by the bank's marketing department.
Definitely not.
They are funded by a hidden tax levied on the merchants.
Every single time a piece of plastic is tapped or a chip is inserted into a point-of-sale terminal, a complex digital handshake occurs between the merchant's bank, the credit card network like Visa or MasterCard, and the issuing bank.
And for the privilege of processing that transaction and guaranteeing the funds, the merchant is charged a fee.
And that fee is usually a percentage of the total transaction value, often ranging from 1.5% to over 3%, plus a fixed flat fee per swipe. This is the interchange rate.
Which means if you buy a $100 pair of shoes, the shoe store does not get $100. They might get $97. The missing $3 is distributed among the financial institutions, and a portion of that fee is what funds the consumer's cash back or travel points.
But businesses operate on margins. A local grocery store or neighborhood restaurant might only have a net profit margin of 4 or 5% total.
Right.
If the credit card company takes 3% off the top line of every transaction, the business would collapse. So what do?
They raise their prices. They bake the cost of the interchange fees directly into the retail price of their goods and services. The menu prices go up, the cost of a gallon of milk goes up, the cost of a haircut goes up.
And this creates a deeply regressive economic reality. Because the prices of everyday goods are artificially inflated to cover the cost of credit card processing, everyone pays the markup. Even the consumer who walks into the store and pays with physical cash is paying the inflated price.
That is the mind-blowing part of the architecture. The cash buyer is secretly subsidizing the rewards ecosystem.
The person paying with the $20 bill is quite literally funding the first-class airport lounge access for the wealthy credit card user. It is a hidden systemic wealth transfer from cash users to credit users.
It really is. And here's a second knowledge gap that you should absolutely investigate. Exactly how much do small businesses have to mark up their prices to survive these hidden swipe fees?
That's a great question.
The sources tell us the structural markup exists, but calculating the exact percentage impact on the macroeconomy is complex. How much inflation is strictly driven by the escalating costs of premium rewards cards demanding higher interchange rates from local merchants?
And how are laws, like the Durbin Amendment, which capped debit card fees, shaping this battle?
Exactly. It is a phenomenal area for further research. But if we look at what keeps a consumer actively participating in this system, despite the traps and the hidden costs, we inevitably run into the most powerful enforcement mechanism of all.
The credit score performance.
The credit score performance. The credit score is a fascinating cultural phenomenon. Fundamentally, a credit score like the FICO score is just an algorithmic risk assessment. It is a three-digit mathematical model designed to predict the statistical likelihood that a consumer will become 90 days late on a payment within the next 24 months.
That's all it is. It's a tool for lenders to quickly price risk, but it has morphed into a societal metric of moral and financial worth.
It really has.
The sources point out how the system has weaponized the credit score to force participation. You are told you need an excellent score to get approved for an apartment to secure favorable auto insurance premiums. And in many states, employers run credit checks before hiring.
Because the score gatekeeps access to modern life, consumers become obsessed with optimizing it. But this obsession breeds incredibly dangerous misconceptions. Let's definitively review and correct the most pervasive myth in personal finance.
Let's do it.
The false belief that you need to carry debt from month to month and pay interest to the bank in order to build a good credit score.
I cannot tell you how many smart, educated people I've met who believe they need to leave a small balance on their card and pay the 20% APR just to, quote, show the algorithm they're using it.
It is completely fundamentally false.
It's crazy.
The sources clarify this emphatically. The algorithm weighs your payment history and your credit utilization ratio heavily. It looks to see if you are paying your obligations on time, and it looks to see how much of your available credit limit you are currently using. But the algorithm does not care if you pay the balance in full on the due date or if you roll it over and pay interest.
You do not need to pay a single cent of interest to build a flawless credit score. You do not need to utilize chaotic borrowing strategies, and you certainly should never max out your limit to prove you are a robust consumer.
No, in fact, high utilization plummets your score because it signals to the algorithm that you are cash-strapped and over-leveraged.
The tragedy of the credit score system is that it turns personal finance into a performative art for the credit bureaus. People open lines of credit they do not need and borrow money they do not want, strictly to feed data into an algorithm.
They optimize for a three-digit number rather than optimizing for actual net worth and cash flow.
And while they're busy performing for the algorithm, they slowly fall victim to what the sources call the demoralization of forgettable spending.
Yeah, forgettable spending.
When we look at how that $1.2 trillion in national debt actually accumulated, it shatters another major assumption.
Most people assume severe debt is the result of catastrophic events or massive, reckless purchases. They think that happens because someone decides to buy an $80,000 boat on a whim or maxes out a card on luxury jewelry.
And while that happens, it is statistically rare.
Very rare. The reality is much more mundane and, frankly, much more insidious. The debt is built on incredibly boring, forgettable transactions.
It is a Tuesday night takeout order because you were too tired to cook. It is 4 different online streaming subscriptions that auto-renewed. It is an extra $40 at the grocery store because you upgraded to the premium organic items.
It is the death by 1,000 cuts. The friction of spending is so low and the digital integration is so seamless that money just bleeds out of the consumer's available credit.
And the emotional utility of these purchases is practically zero.
Zero. The joy of a random Tuesday night pizza fades by Wednesday morning. You won't even remember eating it 2 weeks later.
The memory of the consumption vanishes, but the liability is permanent. The high-interest debt from that pizza gets rolled into the minimum payment. And if you are only paying the minimums, you might be paying off that specific pizza for 3 years.
The system thrives on the convenience, making the spending frictionless, the purchases being totally forgettable, and the debt acting as a long-term anchor.
So if this is the architectural reality, we're living in a system woven with behavioral traps, hidden merchant fees, gamified rewards, and performative credit scoring. What are the future implications? How do we navigate this going forward?
Well, this brings us to a crucial distinction highlighted by the sources. The stark difference in how the wealthy interface with credit versus the average consumer.
This is a major paradigm shift. The data shows that the average consumer primarily uses a credit card to extend their purchasing power beyond their actual liquid cash.
Yeah.
They use the card to buy things they cannot currently afford in cash, using the credit limit as a bridge to future paychecks.
The wealthy, however, utilize the exact same pieces of plastic with a completely different operating philosophy. They do not use credit to expand their purchasing power. They use credit strictly as a tool for leverage, security, and administrative convenience.
Exactly. They use it as a firewall between the merchant and their actual checking account to protect against fraud. They use the extended warranties and purchase protections, and they take advantage of the float.
The float is key. They use the bank's money for 30 days interest-free, while their actual cash sits in a high-yield savings account generating a return.
But the critical differentiator is discipline. The wealthy strictly control their utilization. The card is a payment mechanism, not a loan vehicle. This requires a fundamental redefining of financial strength.
The marketing departments of these massive issuers want you to believe in the illusion of the premium metal card. We have all seen the targeted ads for these cards.
Oh, yeah?
They are forged from titanium or stainless steel. They are physically heavy. When you drop them on the table to pay for dinner, they make a distinct, loud clack sound.
And they come with $600 annual fees, exclusive airport lounge access, dedicated concierge services. The branding is incredibly potent. The system is designed to make you feel that holding one of those heavy cards and having access to a $50,000 credit limit is a proxy for being wealthy. It is a status symbol.
But access to a massive liability does not make you rich. Having a high credit limit just means a bank has calculated that they can extract a lot of money from you over time.
The sources define true financial strength very clearly, and it flies in the face of credit card marketing.
True financial strength is not defined by your capacity to borrow capital quickly. True financial strength is the ability to live comfortably and securely without ever needing to become dependent on borrowed money at all. It is measured in liquid cash reserves, invested assets, and positive cash flow, not in available credit limits.
That reframing is essential. So how do we practically apply this? Let's summarize the ultimate guide to using this highly engineered tool safely, based strictly on the mechanics we've discussed from the sources. We can distill this into 4 practical rules for the future.
All right, let's hear them.
Rule number 1, treat the credit card merely as a payment layer for money you already possess in the bank.
This is the golden rule. It requires a complete mental shift. If you want to buy a new television for $500, you check your liquid cash first. If you do not have $500 in your checking account, you do not swipe the credit card.
Right.
The card is just a secure conduit to transfer the money you already own. It is an administrative layer, never a supplement to your income.
Rule number 2 is the firewall against the amortization trap. Never let the minimum payment dictate your financial strategy. The minimum payment is an illusion designed by the lender. Your only strategy should be to pay the full statement balance every single month before the grace period expires. By doing this, you completely neutralize the interest rate. Whether it is 15% or 30%, it becomes irrelevant.
Rule number 3 addresses the gamification. Do not chase rewards by altering your natural spending habits. We walked through the math on this earlier. Buying an item you do not genuinely need or upgrading a purchase just to hit a spending tier or earn double points is a mathematical failure.
Earning 2% back on an unnecessary expense means you still effectively burned 98% of that capital. The rewards must be a passive byproduct of your normal, budgeted spending, never the objective.
And finally, rule number 4. For most people, especially those just starting to build their financial architecture, consider starting with a robust, no annual fee card. You do not need to pay a bank a multi-$100 yearly subscription fee just for the privilege of accessing their network.
Unless you are mathematically certain that your organic travel and spending habits extract more value from the premium perks than the cost of the fee, stick to the free tools.
If you adhere to those 4 rules, you strip away the psychological manipulation. You remove the emotion from the transaction. You treat the card exactly as it was designed to be treated by sophisticated users, as a mechanical administrative tool and nothing more.
Which leaves us looking toward the horizon of consumer finance. The credit card has dominated the last 50 years, but the technology is evolving rapidly. Here is a final knowledge gap for you to explore as you leave this deep dive. How will new financial technologies, specifically buy now, pay later applications and digital currencies, alter this debt trap in the future?
It is a critical area to monitor. If you look at buy now, pay later platforms like Klarna or Affirm, they are utilizing the exact same psychological architecture we discussed today.
They break down large, painful costs into smaller, seemingly manageable micro-installments.
Right. They delay the pain of payment to increase conversion rates at checkout.
Exactly. Will these new digital integrations replace traditional credit cards, or are they just creating a much more frictionless, advanced version of the exact same illusion? Are they democratizing finance or just building more efficient traps for younger consumers who avoid traditional credit?
Yeah.
That is something you absolutely need to watch as the financial ecosystem shifts.
As we move into the final synthesis of our analysis today, we want to anchor you back to the core premise of our sources. We said at the beginning we would not be preachy, and the conclusion remains strictly analytical.
Credit cards are neither inherently malicious entities nor are they benevolent financial gifts.
They are brilliantly engineered tools. If you grip the tool firmly, with your eyes wide open to the mechanics of interchange fees, behavioral psychology, and risk pricing, and you exercise extreme, unyielding discipline, you can extract immense value.
You can utilize the fraud protection, the float, and the passive rewards without ever paying a fraction of a cent in interest to the issuer.
But if you drop your guard for a moment, if you allow the delayed pain of spending to trick your neurological wiring, or if you let the comforting illusion of the minimum payment lull you into complacency, the tool instantly snaps shut into a trap.
It is a system perfectly calibrated to catch you the moment your discipline slips.
And that leads us to a final provocative thought. We want to leave you with a conceptual question to mull over on your own. It builds directly on the architecture of the interchange fees and the merchant markups we decoded today, but it looks at the broader trajectory of our global economy.
Think about the systemic push toward a purely digital economy. Physical cash usage is plummeting every single year. Many retail environments, stadiums, and transportation hubs are already entirely cashless, heavily preferring digital wallets and contactless cards.
So, if society inevitably moves away from physical cash entirely, and every single transaction we make from buying a cup of coffee to purchasing a vehicle is mandated to be routed through a centralized, privatized network designed to extract hidden merchant fees and potential interest from every exchange, will true financial independence even be possible?
Or are we hurtling toward a permanent reality where we are all just perpetually renting the ability to spend our own money, paying a private toll on every single economic interaction we have for the rest of our lives?
It is a heavy structural caution, but it is one you now have the conceptual framework to navigate because you understand exactly how the machinery operates behind the curtain.
Thank you for joining us on this deep dive. Take a hard look at the plastic sitting in your wallet today. Continue to question the unseen systems running your daily life, and as always, stay deeply curious.